Hope everybody is doing well. I'm burning the candle at both ends for you. Saturday night, I'm just trying to grind, just trying to continue to get a little bit of information out for you guys. And I'm gonna talk about a few different things that really are just identifying points of market tops, just so that maybe if you don't know some of this information, um, you know might be informative for you, and maybe it'll help you make a decision, or be able to kind of see things in the markets, the economy, the charts, um, the data reports, things like that. So a couple just facts about history. I won't go on too long, but I am going to give you a lot of facts in this video. But since the year 1900, there has been 29 bear markets, and the average decline was 29%. They show up on average every 3.5 years. They last roughly 3 years, okay, from the time they start to the time they come back to even. That is a time of decline of 1.7 years, and another incline back to even of 1.9 years on average, okay? Bear markets consumed 32% of the time in the market. So, like, for instance, if the bear market consumed 32% of the time, and getting back to even took another 44%, that means that there was only a net gain of 24%. And that is why you don't want to have 100% of your money in 100% of the time, because you don't need to risk your money all the time if it's truly only going up 24% of the time. Okay, those are all historical facts. Okay, not opinion. So a wise investor knows not to be in 100% of the time, because they know with complete certainty, based on the history of the stock market, that there is always a 30% or 29% on average bear market, okay, every 3.5 years. Some are further, some are longer, some are shorter, some are deeper, some are more shallow. So some might be 50%, not 30%. Like, for instance, the financial crisis. The indexes went down 50%, the stocks went down 70 to 90%. Same thing with the dot-com crash. Same thing with the crash in 72 through 74 with the Nixon Watergate scandal that was televised on TV, and the OPEC oil embargo. And yeah, so about every 20 years or so, there's what's called a secular bull run, okay? And a good example of this is 1981 all the way through 2000. And a lot of money managers will reference this amount of time. In fact, I'm already seeing it happen in the news. Oh, when the rates are raised in these time periods. No, man, you got to look historically. See, there's always so many secrets. This is why I'm not big on the news, because I call BS a lot, and it frustrates me because I know better. I know a lot of people don't know better, but I know better. 1981 through 2000 was a secular bull market. It was one of two rallies ever in the history of stock market, since the beginning of the stock market, that rallied in that fashion for that amount of time. Now, the reason that particular one rallied, part of the reason is because it has to do with the group, the baby boomers, from my understanding. So there was a lot of people that were at the, around the age of 45, and I got to read up on it a little bit more, but it has a lot to do with people investing, and a lot of people were born prior to that and at a specific age group. And there was also technology developing, which had a lot to do with it. However, there has been technology in a lot of eras as well. So I'm not saying that only that era had technology, but it did. It had the internet. It had cell phones, it had pagers, it had computers, it had a lot of technology in that era. It's you have to look at all of it. You got to look at the whole puzzle, not just a piece of the puzzle. Okay. Um, Now, when there's secular bull markets, after a secular bull market, always following the secular bull market is a secular bear market, which is if the price action and indexes are declining or going sideways. And they always follow each other. That's just what happens. They follow each other. Even though the bull markets and the bear markets are shorter, the secular bull and secular bear are longer. So, if you go into a long bull run, um, and it's time for that secular bear, then you can go into one of those longer bear runs as well. This is why like buying and holding is probably not for me. It's not the best way right now, nor is dollar cost averaging because there's too many unknowns. There's too many variables. Saying that you're going to buy and hold forever through this is like me telling you that, yeah, you can walk from Los Angeles to New York as long as you put one foot in front of the other. Well, yeah, it's a true statement. You could probably walk to New York if you put one foot in front of the other. But there's all kinds of variables that are going to happen that could like make that difficult. And that's why I always say, like when you spot market tops, there's multiple pullbacks. One, two, and there's usually three at the topping pattern. It's already making the lower highs, so I'm assuming that that's probably coming. Now, there's a whole bunch of different things that I can discuss that are factual and help you guys, and you guys can say, hey, you know what? We have that symptom. We have this symptom. We have, I can give you like 30 or 40 of them, to be honest. And I already know that we have a lot of them, okay? For instance, one of the symptoms is that the first thing to break is the small caps, and it happens many, many months prior to the other indexes break. Does that happen? Have we had the Russell break? Is it still in the red ribbon and it's not growing? Yeah, it is. Have we had the two pullbacks out of three? Yeah, we have. Are we making lower highs? Yeah, we are. Are railroads and heavy equipment manufacturers rallying, which only happens at the end of a bull run? Yeah, we are. What has put us into a bear market historically? Just about every time that we've had a end of a bull run in a bear market. Well, that was the Fed coming out and saying we're going to raise rates 3 times or announce that they are. It's almost like a signal. If you know, like Illuminati or Masons, and I'm tinfoil hat, take it for what you will. Okay, it's kind of like a signal. It's from the playbook. Every single time they come out and say we're raising rates 3 times or announce it, that happens. It always happens. Okay, so it's kind of like a signal. Hey guys, we're raising rates 3 times. We're announcing it. Let's pull your money out. And guess what happened? $6 trillion got pulled out of the market. Now, what makes a market break? Well, a lot of things make a market break, but I'm going to stick to topic. So when $6 trillion gets pulled out of the market, it also becomes a great shakeout. Okay, and a lot of people get nervous and they sell lower than they bought, and they cut their losses, and they're out. And so now you have institutions which are like pension, education, hedge funds, all of them, all the big money, and they pull money out, and then it shakes out a lot of other people, and then that creates a lot of weakness, creates underlying weakness. And then you start getting about 60-70% of all your stocks under the 200, which I believe it's something like that now. And I know that we've lost 50%. It might even be a little bit more, like 52-53%, but I'll just say 50% of all the value of the stock price from 1 year ago. And so this is why I think we're already in a bear market, and this is why I'm already in cash, and this is why I'm just taking like shots going up and down on small time frames, because I hope I don't have to sneeze. I feel like I do. Okay, so if you know that like bear markets show up every 3.5 years and they last for 3 years, and recessions show up every 5.8 years. I mean, and you know that there's only a net gain 24% of the time because of these huge drawdowns back to break even, like 1929 took till 1955 to break even. 2000, 2007 and 8, that took like all the way to what, 2018, 19 to break even. 1964, it took 18 years to break even. So those big drawdowns to break even evaporate all those years, okay? That's why people can only make 7 to 10%. Unless they're, doing it like the way that I do it and you amass money. Now I'm up 30% on the year. I could get in trouble. I mean, it's the markets. It's dangerous out there, I mean, I know that it's dangerous, but I'm also very good at it, and I think that anybody can do what I do if they really like applied themselves with the courses. They did the one-on-one coaching with me, and they did it exactly like I do it. You got to be quick. I mean, I move up and down fast. Like sometimes I'm buying literally, 1 minute long, 1 minute short, and I'm identifying things on longer trends. Like, are we in an overall uptrend on the daily, the 4 hour, the 1 hour? Okay, so I'm going to wait for it to go, to a downtrend on the minute, and then I'm going to come in off the pivot on the minute because I'm protected by the overall trend. Like, I have to change my strategies all the time for market environments. That's what it takes. You can't just do like the type of trading that I love to do, that a lot of the people I look up to do, and the way that I'm trained and I do it. It doesn't work in this market. But my system definitely works in this market, and it also works in all the markets. But it works really good in this market. However, because the market is extra volatile, and I've mentioned this in, 10 of the videos at least, when the market is really, the market environment depicts the time frame. So if the market is super volatile, the time frame gets shorter. If the market is super stable, then the time frame is longer. So that's why I'm closing out my trades at the end of the night. And I don't like doing that. I want to keep them in, but it is what it is right now. So, back to like, if the market only went up, then, you'd be making more than 7 and 10%. Well, in 1981 through 2000, the market, the S&P averaged 16% actually. So in order to get, 10.5% on average, what has to happen in a secular bear market? Well, you have to average 5.5%. So you have to average 5.5% for the next 20 years to average the 10.5% that historically the S&P has risen. Okay, so if the secular bull market gave you 16% and the bear market has to do 5.5 to give you that average. So take this stuff into consideration. This is why buy and hold in DCA in this market is really, really dangerous. Okay, I've mentioned multiple times, if you bought Microsoft and Intel at the top of the .com crash, it took you 10 years to get 1/3 of your money back. Are Intel and Microsoft great companies? Yeah, great companies. But remember, a lot of the leaders, that were leaders in the last bull run might not be in the next bull run. Okay, that's highly likely that will be the case. However, I am a believer in investing in companies that not only will be here, but are changing the world for the better. And I'm sure, Microsoft will be in there. I just use it as an example. But there's a ton of stocks that if you were to buy and hold forever, they actually went bankrupt. They didn't make it through a bear run. So you actually did lose 100%. You didn't just lose 90% or 70%. You lost 100%. That was a lot of stocks. A lot. I mean, Enron comes to name, Polaroid. I mean, there's a gamut, guys. I mean, if you want me to do a video on like, the top 100 big companies that went bankrupt or investors lost a ton of money, I guess I could do a video on that. Probably actually sounds kind of cool. But look, there's a lot of stuff going on. You get the heavy equipment manufacturers and railroads. Okay, that only happens at the end. You get the lower highs. It's bad. Remember, in an uptrend, you go up and pull back and up and pull back and up and pull back and up and pull back. And you're making higher highs. pull back up, pull back up, pull back. This was a little tight. It was like a base. Pull back up, higher high, pull back up, higher high, pull back up, higher high, and now you're making lower highs. You're starting a new direction, okay? This is a new direction, all right? See how we've been going up for a long, long time? Well, now you're going in this whole other direction. So just like technical analysis people can predict, they can say, like for instance, I told my brother back in January of 2021, he was like, where do you think Microsoft will be? He's owns a lot of Microsoft. And I basically just did a trend line like this based on the trend line that I had for a long time. And I said, it's going to be, I think I said like, I can't really remember. I was really close. But it was like an $80 gain that I called out like 10, 11 months early. And I was off by a little bit. Microsoft beat me. I did that by doing a trend line. So when you're making lower highs like this, and maybe some people don't believe in technical analysis, I do, okay, very, very much, and I believe it works. But this NASDAQ now, if its all-time high was 16,200, and you're currently sitting at 14,797, you're already, so you got like 1,400 points. Okay, you're at the 200, you're making lower highs. I mean, if it breaks, which it has a red ribbon, and you guys know what that means if you watch my channel, that could be bad. That could go on for a long, long time. Take it right here. On July 22nd, 2022, it's saying it's going to be at 14,000 points if it keeps following that trajectory, which is now becoming a descending triangle, which is a bearish pattern. So you have an uptrend and now you have a downtrend, okay? And that's just the way the cookie crumbles, you know? You had this long uptrend and now you started a downtrend. I mean, you gotta see this stuff early, guys, because I want you to understand something. If you haven't been watching the channel and you're not a Jedi in the Discord and you don't understand, you know, the participation phase, the accumulation phase, the distribution phase, and you don't understand all that stuff, that's totally fine. But you want to trade with the trend. So here you're going long, okay? You're making higher highs, all right? There's 4 phases. Here's the first one. Here's the second one. This appears to be the third one. And the fourth one comes down as far as the last one, okay? It can come way down here. I don't think it'll go that far, but it can come all the way to the base of here. Oh, that would be bad. I mean, I don't know if it'll go that far, but I mean, you gotta understand these are supports. These areas right here, these are all. I mean, I haven't even done this. Jesus. I mean, this thing could essentially do a number like this. Okay, it might get down right here to 12,394 on the NASDAQ. Or possibly this thing goes deeper down and it catches this one over here of 9,882. Well, if it went from 16,200 to 982, it's a 61% drop. Yeah. So if we were at 16,200 and we're already down 1,400 points and it could come down this descending triangle down to here, or possibly even here, if it goes from top to here, that's a 61% drop. That's happened before in the stock market. Typically, they're 29%. Some of the bad ones, like the .com and the financial crisis, were they were like 50%. Also, the one in the 70s, and everybody knows about the 1929 crash. The trick to like maneuvering the markets is understanding the economy. And the economy shows up in the indexes, and the indexes are a leading indicator back to the economy. They work in tandem, okay? So like the Dow theory, like the Dow is the barometer for the health of the economy. If something goes wrong in the Dow or something goes wrong in the economy, it's going to show up. Like the Dow will lead us into a bear run and a recession, and the Dow will lead us right on out. Okay, as businesses are coming down, the Dow will lead us right out into expansion, which is when the Fed will lower the rate, because that's what they're doing now. They're raising the rate to do this now so that later they can lower the rate and pull us out. And they're doing that simply as a temporary band-aid to get money out of the system, to lower inflation, and to protect the value of the US dollar and the world reserve currency. And every 5.8 years, a recession happens. It's just interesting that our current president was the vice president the last time we had a recession, if I recall. And now he's the president. That just dawned on me right now. Yeah, not good. We might have a tough time in those midterms. People don't like inflation. Okay? People don't like that. People like it when the economy is running good and there's all kinds of jobs and there's spending and people just want to be people. They want to go to work, want to make money, they want to be with their family, they want to enjoy life, they want to go out, they don't want to wear masks, they don't want to not be able to get their kids to school, which is the problem that we're having out here by us. Like, I guess we spoke to the principal of my girl's daughter's school, and like a ton of the kids are sick over there, and it's getting to a point like they might not even keep the school open. In fact, she's already doing the at-home thing again. So it's like, yeah, I know. And look, another major thing that that definitely will lead us down into a bear run and most likely a recession is a slowing economy. And not only does the U.S. have a slowing economy right now, and we do, despite what you have heard, our economy is slowing. Okay, it is slowing, and you put that with an interest rate hike and $6 trillion being pulled out and the great shakeout and all these other symptoms, and you put all that together, and then you add in that China is definitely going to have slowing growth in GDP. In fact, I've seen a whole thing. They've been talking about it all weekend on Bloomberg. You have two major economies having slowing growth. You guys just got to understand, man, the market was propped up. It was supposed to be propped up. They wanted you to stay home. They wanted to send you checks, stay home, throw it in the market, have some fun while we figure out COVID, because we don't know what we're dealing with. And you do that, stay home so we don't have to deal with that. They were letting people not even go to jail. They were letting all kinds of stuff. Riots were happening. You guys remember, okay? Like, stay at home. Let me send you some money to keep the people at peace and happy. They used to do that in the kingdom days, in the, back in the, centuries ago. All the kings, like, there'd be all this stuff, and they would do certain things, like they would have a festival or a feast, or they would give them money, or there's this is stuff happens like this. I mean, this is old school government. It's kind of stuff they do, or just modernized a little bit more now. But if you look into history, like certain things like this have happened before. So bull markets don't start easy, and bear markets don't start easy. They don't go easy. So the thing that the small caps have come in, from a long, the small cap started falling a long time ago. That's, that's a bad indication, and usually what'll happen, I'm just going to say it before it happens. Usually what'll happen is the small caps and Russell will fall first. Just about every time the Russell will do that. They'll pull up money. There'll be a great shakeout. All these other symptoms will happen. Then you'll see the lower highs, which just started, okay? Red ribbon. And once the NASDAQ goes and the Russell goes, it's just a matter of time before the next one goes, because you and I, we can't hold the market up with institutions not putting it in and them just all shorting and whatnot. So we can't really hold it up. And plus, people are going to put money into bonds. They're going to move it to cash. I mean, this is all just like gold even, so, precious metals, stuff like that. But look, I mean, like I try to tell you guys, I have a system. I can show you. Go in the Discord and ask anybody that's done a Wheelhouse Wednesday group training, because I do it for members that aren't even upgraded sometimes. And just ask them, because I noticed that I get the most subscriptions when I do the free group trainings because I think so many people attend those and then they're blown away at the stuff I teach them. They can't even resist but sign up. They're just like, whoa! Like I have this guy. He's real cool. I talk to him all the time. He's into stocks and stuff. He's a cool guy. I've known him for I don't know how long I've known him. 4 or 5 months maybe. I'm not sure, but he just upgraded and he's doing the courses right now. And he hit me up tonight and he was like, I am learning so much so fast. I had no idea. I loved hearing that. So, and I think he came into the Wheelhouse Wednesday group training and when I was teaching and him and about 5 other people just had to upgrade because I'm sure people are losing money and that's what I'm here to do is help you guys kind of navigate that problem. How to spot a market top, how to get out. That's why I'm always, if you go back through my videos, it's like, I'm saying right here on this candle, guys, move to cash. I'm saying on this candle, move to cash. I'm saying on this candle, move to cash. I'm saying on this candle, move to cash. All before these huge things. It's because I know not only what I'm looking for, and I've been doing this a long time, but I have this system that completely tells me. I mean, it literally does exactly what it's supposed to do, and as long as I do what I'm supposed to do and read it properly, I get out. I don't question it because it's right all the time. It's right all the time. Remember, I tweaked all my settings and rewrote everything. And the guy that makes this indicator doesn't know this indicator, and they don't know each other. And I went and I tweaked them all, and I do pattern recognition, and it's just something I'm good at. I notice a lot of pattern stuff all through the world. I don't know if maybe I'm dyslexic or something. I'm not dyslexic, but I don't know what's up with me. But I just see all these things, and not just on technical analysis, but all kinds of things. I don't know. It's just very strange. I can remember people's names and I remember weird flashes from way back that are you should forget. But then certain things did I put the mayonnaise in the fridge? I completely forget. I don't know. But other things I'm it's just it's in there. And I don't know, it's strange. So when you get to a market top, you have to get out of margin. You guys have to remember, if you're in margin and it goes down 20%, and your stock goes down 20%, you just lost 40%. If it goes down 50%, you lost 100%. So that's why you also need a position size. But when you see the tops, like I teach you how to get out, and I'm showing you right now, then you want to first thing you want to do is get out of margin, hit the market sell button. You don't even want to do limit orders. When you see it go topping, you just get out, boom, 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 which you guys should have already done. You shouldn't be in. I don't know. I'm not. I'm just coming in and I'm riding the momentum. If it's a down day, I'm riding it down. If it's an up day, I'm riding it up. Like I was saying, you're going up and then a pullback and up and a pullback and up and a pullback and up and a pullback and up. These are trending up its higher highs. Well, it does the same thing when it trends down. It goes down and pulls back up, but it didn't go as high as this one. Down and pulls back up, but it didn't go as high as this one. Down and see how this is blue. It didn't pull up as high. And down, and if it pulls up, it's just going to continue making lower highs. We're at the top. Is what it looks like to me. And I listen to there's some really good channels on YouTube. They're professional channels, there's trading channels, there's coaches out there. There's some really good ones, some really good ones. And but these guys are dedicated, and this is what they do. And there's some really good channels out there. There's just some really bad ones too, but there are some really good ones, and those are the ones I enjoy listening to. A lot of the trading channels and the guys that are professional and follow the systems and they understand markets and so I definitely like all those guys, but they're all worried too. I mean, they all see what I see. Not that they're worried. That's probably not the right thing. They just see what I see. They see the lower highs. They see the symptoms. They see the topping patterns. People just know. It's like a signal, remember? It's like the Masonic handshake. I mean, look, when Alan Greenspan raised the rate in September of 1987, the market completely broke 1 month later in October 1987, okay? you got to understand there's like 10,000 institutions, okay? All the pension and hedge funds and educational and all these banks, and so when they start pulling money out and it becomes a consensus, the consensus is always right in the market. That's why you got to listen to the market. You can't fight the market, can't fight the trend, can't fight the market, can't fight the consensus. That's why my system works so well, because I don't fight any of it. I'm non-emotional with it. I go where it wants me to go. I do not question it. That's why I make so much money, because it literally, when it's going up, I don't question it. And when it says to get out, I don't question it. And when it says to go down, I don't question it. When it says to stay in because it's going to go down more, I don't question it. I just keep riding it and making money. And, that's it. So, yeah, that's why I don't worry about a stock market crash. Also, I'm extremely diligent with my stop losses. So if I have something, I buy in, like as an example, let's just say I bought in here on this candle. And here, I'll draw a line so we can just see it. So I bought in on this candle. There's a little pivot right there. And boom, I got my stop here. This is low risk. This is high reward, hopefully, as it goes, right? I'm in an uptrend. There's my blue ribbons. So as it keeps going up, boom, my stop moves to there. Then it moves to here. And then it moves to here. And then I got stopped out, it looks like, which is fine because capital protection. And it goes up, and I have a new stop. And I go up, and it goes, and stops me out. Okay, the market's getting iffy. It's 2 times I've been stopped. And you just keep going. But basically, it raises, move your stop, raise, move your stop, raise, move your stop, raise, move your stop. When it comes down, boom, it moves your cash and your profits to the side. You just rinse and repeat, guys. You just don't have to hold forever. Dollar cost averaging, you certainly don't average down. You don't buy the dip. You don't do that ever. Okay? You don't add insult to injury. In fact, I bought a new book. Pretty much thought I had read all financial books, but I got a new one. It showed up. The very first freaking chapter and the second and the third are all the stuff I've already been telling you. I haven't even found anything new in there. And guess what? You know what? Here, let me just read you what they say about the freaking dollar cost averaging in here. Oh man, you're not gonna like this. Okay, so I'll just read a brief part of this. So it says, these patterns and trends have held true for more than 100 years. This is why diversifying will not prevent losses. One of my first videos, I was like, you don't have to diversify when you're like a super ninja assassin. Diversification is for like people that don't really know what they're doing. That's like, you don't need to be overly diversified when you're like super sniper. You just need to, you can raise your position size. You can do all that stuff. I don't talk to you guys about on YouTube that much about big position sizing and all this risk because I don't want you guys to do that. I go in with the assumption that that's dangerous for a lot of people. But when you're really, really good, you don't need to. You can have more size and you don't need as many positions in diversification. So it says this is why diversifying will not prevent losses. When the overall trend is down, any stock investment is on the wrong side of the market and the trend. This is why dollar cost averaging or averaging does not work when the market is going down. You don't know how long the market will go down. And adding to a losing position is a loser's game. An average loss is still a loss. You never average down. This is one of the most important factors in trading and investing that you must know. Staying on the right side of the market means you must recognize the overall market trend and invest and trade with that trend no matter what. So when I say all books say not to buy the dip, not to average down, trade with the trend, I just bought a new book. I'm 4 chapters in. It's telling me all the same stuff I've already been teaching you. Because it's the right way. So I don't like dollar cost averaging in this market. You don't know how far it's going to go down. People that buy this dip right now could be at the very beginning, okay? I want you to just imagine something. See this down here? Imagine that this could fall all the way down, back down to here, okay? Like they make their mountains and they do from time to time. Let's just put that in your head, that could happen. Okay, I don't think it will, but let's just say it does. So if you were buying the dip at the very beginning of the top of the mountain and it was going to come down, you're going to be buying a lot of dip to the point that you're bankrupt and mortgaging your home. So don't buy the dip because you don't know where the floor is. And honestly, the dip looks like it's just beginning. So don't buy the dip, don't average down. And that's what the author is saying in that book. And that's what I've been trying to say in just about 75 videos that I've published. All right, so I found something interesting to talk about here. So I figured I'd walk you through a little bit on some of the big crashes. So let's just take a look at the prolonged 2-year bear market of 73 and 74. I think it's an important one to understand. So this is the one I was telling you about that had the Nixon Watergate scandal, and then the OPEC had the oil embargo, okay? Now, it was the worst stock market catastrophe up to that time since the 1929 and 1933 depression. The Dow corrected 50%, but the average stock plummeted more than 70%. I had told you guys that. This was a big lesson for stockholders and was almost as severe as the 90% correction the average stock showed from 1929 to 1933. However, in 1933, industrial production was only 56% of the 1929 level. More than 13 million Americans were unemployed, okay, back in 1929. The peak unemployment rate in 1930 was 25%. It remained in double digits throughout the entire decade and was 20% in 1939. Jesus. Okay, that's bad. The markets were so demoralized in the prolonged 73-74 bear market that most members on the floor of the New York Stock Exchange were afraid the exchange might not survive as a viable institution anymore. This is why it's absolutely critical that you study the market averages and learn how to protect yourself against catastrophic losses for the sake of your health and your portfolio. Ooh, what have I been trying to tell you guys? Literally, I can just grab any book. They're all just going to tell you the same stuff. Like, it's the right way. This is not, these books that I read, they're not fiction books. It's not like Indian in the Cupboard or some mystery. You know, this is like factual, you know, it's factual. It's not opinion and it's not fiction, okay? This is like the real way, okay? What else? So here's something. Let's talk about the myth about long-term investing and being fully invested. So many investors like to think of, or at least describe themselves as long-term investors. Their strategy is to stay fully invested through thick and thin. In fact, most institutions do the same thing, but such an inflexible approach can have tragic results, particularly on you, the individual or retail investor. Individuals and institutions alike may get away with standing through relatively mild bear markets, such as 25%. But many bear markets are not mild. In fact, most are downright devastating, such as 73, 74, which we just talked about, 2000 through 2002, and 2007 through 2008. Here comes another part I always talk about. The challenge always comes at the beginning. This is why I say when you spot it at the top, you get out, you don't question it because you don't know if it's going to go down 2%, 3%, 5%, 10%, 12%, 15%, 20%, 30%, 40%, 50%, 60%, 70%. You don't know. So why gamble? Why risk it? In fact, we're going to talk about gambling. We're going to talk about something Jesse Livermore said that's going to surprise you guys. Okay, we're going to talk about speculators and investors in a minute, actually. We got another topic. Saturday night, I'm doing nothing. I'm talking to you guys. We're going to have some fun. All right, so the challenge always comes at the beginning when you start to sense an impending bear market. That's like right now, okay? In most cases, you cannot project how bad economic conditions might become or how long those bad conditions could linger. So in 1969 through 1970, the war in Vietnam, inflation, and the Fed like tightened up money supply. It helped turn the 1969-1970 correction into a 2-year decline of 36.9%. Before that, bear markets averaged only 9 months and took the average down 26%. So basically, what they're saying is when the Fed raised the rate that time, it changed all of history in the stock market, because prior to that one monetary tightening where they raised the rates, it was the average was 26% decline, And this one jammed all the way up by 40%. It's a big deal, guys. That's why I keep trying to tell you the fund rate and the discount rate are major, major indicators. So look, most stocks fall during a bear market, but not all of them recover. Remember I told you, like, you don't want to be long term because hundreds of stocks they go down 100%, they go bankrupt. A lot of them this is what happens, okay? It's like a filtering, okay, the way the economy works. Okay, the signal, 3 rate hikes, the Masonic signal. They pull out the 6 trillion, the great shakeout. It breaks. Then what happens is the big companies, the Nvidias, the Apples, Microsofts, they swallow up all the small companies, and it's called a consolidation. It's called a cleansing. It's like a cleansing, okay? That's just what happened was supposed to happen. What's about to happen is supposed to happen. They know it. In fact, they knew what they were going to do back in the Wuhan days, baby. I bet you I'm right about that. This whole thing is premeditated. This is like, they're going to talk about it on the news, and they're going to play the game, and the other YouTubers are going to play the game, and I'm just going to tell you straight up, like, yeah, I can make 50 videos and probably get a whole bunch of likes and views, but remember, I don't really care about all that. Like, I don't really care. Like, what I care about is just helping people and just trying to get the word out and just try to educate people. Because if you watched my video yesterday, the whole reason I did this out of retirement is because I was frustrated with the misinformation on YouTube and the definite misinformation on Facebook. So, and again, there are some sick channels, but they're trading channels. There's like professional trading channels and really good companies, and those companies are really great on YouTube. But oh, we already talked about this. I keep talking about this. The divergence of the macros is critical, okay? And then we're having that problem right now. The Russell and the NASDAQ are diverging from the Dow, and what that is it's a consolidation. Investors are pulling money out of tech. It's not just a rotation, it's a consolidation into safety. And when that happens, that's another indication of a topping pattern, and we're at the end of a bull, okay? Certain psychological market indicators might help. Advanced decline line, which is market breadth, okay? So when there's more advancers than decliners, that's market breadth, so that's something that you want to watch. Federal Reserve Board rate changes. Federal Reserve Board rate changes, okay? I told you about the discount rate, the federal fund rate. So when these rates are altered by the Fed occasionally, then stock margin levels are valuable indicators to watch because, as a rule, interest rates provide one of the best confirmations of basic economic conditions, okay? And changes in the discount rate and fund rate are by far the most reliable out of all the leading indicators. That's why I keep like talking about this like rate thing and the 3 and the signal and like how it's supposed to happen. And while I don't know if everybody is, but most people that I click the button, most people are scouring the internet trying to find reasons, just like they were scouring the internet to find out why Bitcoin was falling. Here you go. As a rule, interest rates provide the best confirmation of basic economic conditions, and changes in the discount rate and Fed funds rate are by far the most reliable. In fact, in the past, 3 successive significant hikes in Fed interest rates have marked the beginning of bear markets and impending recessions. Ooh, the Fed and how it crushed the economy in 1981. The bear market and the costly protracted recession that began in 1981, for example, came about solely because the Fed increased the discount rate in rapid successions on September 26th, November 17th, December 5th of 1980. Due to that succession and the 4th increase on May 8th, 1981, thrust the discount rate to an all-time high of 14%. That finished off the U.S. economy, decimated it, all of our basic industries, and the stock market for the time being. The Fed rate changes, however, should not be your primary market indicator because the stock market, this is true, and I said this earlier in this video, the stock market itself is always your best barometer, like the Dow theory. So yeah, the stock market first, leading indicators, then the Fed rates, and then all the other stuff. That's why I keep focusing on it. Now, talks about the 2008 financial collapse. The subprime mortgage meltdown and financial credit crisis that led to 2008 market collapse can be easily traced to moves in 1995 by the then current administration to substantially beef up the CRA, which is the Community Reinvestment Act of 1977. I don't know if a lot of people know this. These actions mandated banks to make more high-risk loans in lower income areas than they would otherwise have made. Failure to comply meant stiff penalties, lawsuits, and limits on getting approvals for mergers and branch expansions. So the banks, this is why they got bailed out, because even though the media and everybody's like, oh, the banks did this, and they did, believe me, it's bad. Okay, they're greedy, and they did it. But they also were pushed into a position by a federal regulation to do it. And that's just not the story you hear on the news sometimes, you know? So, our government, the U.S. government, in effect, encouraged and coerced major banks to lower their long-proven safe lending standards. Most of them, more than $1 trillion of new subprime CRA loans had adjustable rates. Many such loans eventually came to require no documentation of the borrower's income, and in some cases, little or no down payment. It's crazy, right? 1962, what broke the market? Another notable stock market break occurred in 62 in the spring. Nothing was wrong with the economy, but the market got skittish after the government announced an investigation of the stock market and then got on the steel. Oh, John F. Kennedy. This was the Kennedy thing. Oh, yeah. So, okay, in 62, basically what happened is the John Kennedy, or his brother, Robert Kennedy, he came out and he announced, I'm going to investigate the stock market. It freaked the stock market out. Then John F. Kennedy lit a fire on the steel companies. Okay, like he was going after them. And what ended up saving that one, now this collapsed the stock market. This was bad. But you know what? And by the way, this is also when the Cuban Missile Crisis was going on. Okay, so, okay, I'm going to tell you, this is a really unique one. Okay, so the catalyst was actually our president coming down on the steel companies in the United States and an investigation on the stock market in general. And we had, possibly a war and a missile crisis going on. But what pulled us out of that was actually them backing down. Let me see if I can find that. So that fall, after the Cuban Missile Crisis showdown with the Russians, a new bull market sprang to life. All of this happened with no change in the discount rate. So that time was a severe crash without a federal fund rate change or a discount rate change, but it had to do with the Cuban Missile Crisis and catalysts from Robert and John Kennedy. Oh, here's one of those other things that your boy Chris at Wheelhouse talks about. Should you average down? This is from the book, and it's factual. I'm not reading a fictional book. One of the most unprofessional things a stockbroker can do is hesitate or fail to call customers whose stocks are down in price. That's when the customer needs help the most. Shirking off this duty is in difficult periods shows a lack of courage under pressure. About the only thing that's worse is for brokers to take themselves off the hook by advising customers to average down, somewhat known as buy the dip. Averaging down means buy more of the stock that is already showing a loss. If I were advised to do this, I'd close my account and look for a smarter broker. You guys believe me now? All right, now let's talk about this. Are you a speculator or an investor? And then once I'm done with this, I'm going to close it down. So these are two often misunderstood words that are used to describe the kinds of people who participate in the stock market: speculator and investor. When you think of the word speculator, you might think of someone who takes big risks, gambling on the future success of a stock. Conversely, when you think of the word investor, you might think of someone who approaches the stock market in a sensible and rational manner. According to these conventional definitions, you may think it's smarter to be an investor. Bernard Bach, who was an advisor to multiple US presidents, defined speculator as follows. The word speculator comes from the Latin speculare, which means to spy and observe. A speculator, therefore, is a person who observes and acts before the future occurs. This is precisely what you should be doing, watching the market and individual stocks to determine what they're doing now and then acting on that information. Now, Jesse Livermore, another stock market legend, defined investor in this way. Investors are really the big gamblers. They make a bet, they stay with it, and if it goes wrong, they lose it all. Look, guys, you don't buy the dip, you don't average down, you don't add insult to injury, you know how to get out of tops, you know how to identify bottoms, you buy in on the pivot, you identify a floor, you definitely use capital protection, you be careful with position sizing, you don't have to trade every day. Look, man, I'll teach you everything. I'll literally teach you how to be a wizard, okay? If you want to be like a super sniper fast trader, I'll teach you that. If you want to learn, swing trading, I'll teach you that. If you want to learn crypto trading, I'll teach you that. If you want to learn investing, I'll teach you that. It's probably not the best time for the investing as you just watched this video. But yeah, hit the like, subscribe, select all. Do me a favor, jump in that Discord for free. Ask people what they think of the Wheelhouse Wednesday group training. Ask people what they think of me. Ask people what they think of the courses. If you're thinking about it and you're tired of losing money and it's been tough for you, which it's probably going to be a lot tougher if you don't have a support team and a support system and a coach, and it's just probably going to be a little bit more difficult. And I'm here for you. And you can go right in there. You can ask people and see what you think. And you can DM me too. You can DM me directly. A lot of people just DM me directly, and I talk with them and I help them out. And I even help them out and just look at their stuff without them paying for anything, just to kind of get to know them and build a rapport. So just jump in there. The Discord link is in the description. Also, my Webull account, Webull hit me up, and I've referred a bunch of people. So now they're giving away $2,300 in shares, and they loaded up the random generator with a whole bunch of Apple full shares and then Amazon fractional shares. They have other stuff in there too. So you guys can click that link if you don't have Webull. Get in the Discord. I appreciate you. Usually I don't read to you, but I feel like the real topic that needs to be talked about is like what's about to happen. And I don't think everybody quite really knows the gravity of the situation quite yet. So I'm hoping that you guys on this channel respect it, that I'm trying to help you. And I hate being a bear. I love being a bull, but every 3.5 years, I guess you got to be. Sometimes you just go to cash and buy bonds. Sometimes you just short the market. But looks like it's going to come down, so it's just a matter of time now. And just be prepared. I'm in cash, and I'm just going to jump in, up or down, in and out. That's like my deal. Teach you how to do it. Already up 30% on the year, and I plan to go much, much further than that. And I don't think it's going to be as hard as many people make it out to be, because usually people are literally their own worst enemy when it comes to this kind of stuff. They don't follow a system, or they don't have a system. They, they're literally their own worst enemy. And I've figured out all the problems, all the solutions, and I have all the rules and conditions for myself so that I don't get out of line and I keep myself in check. And that's what rules and parameters and conditions are for, to keep yourself in check. I know that if the 200 and the 50 and the 9 EMA are below me and the price action's piercing the 9, I get in, especially if it's the leader in the right sector. And then I just know if it's going to come back through the 9, I'm out. Like, that's a rule, that's a condition. I know that I'm not going long unless I'm above that 200. Like, I just have all kinds of rules, and I've explained them to you. I'm looking for trend. I'm looking for momentum. I'm looking for sectors. Right now, it doesn't matter as much with everything like, in this current market, you don't have to have like the leaders because you can't hold a stock for too long. It's too volatile out there. But what you can do is definitely be in the right sector. So last week, when I made a ton of money, well, energy was popping. I was all over energy. I wasn't just like diversification. I have one energy play. No, I hit like 12 of them. It was like, I just bum rushed energy. I was hitting triple leverages. I mean, I'm literally hitting triple leverage up and down, bull and bear, revolving multiple times a day, intraday. And then I'm hitting like the sector super hard, and Yeah, I mean, I just know how to play the game. Remember, if you don't know the rules, how are you ever going to win? Well, I can be your coach. I can help you win. Who loves you, baby? Welcome to the wheelhouse.